So we continue with economics of profit and losses. So today we're going into shifts in cost and revenue curves. So we have cost. What brings about a shift, an upward or downward shift in the cost curve? And what brings about an upward or downward shift in the revenue curve? So shifts in cost curve are primarily caused by variations in input prices like wages or raw materials, technology or government policies like taxes or subsidies. So we have shift in the cost curve based on the fact that the cost of production changes over time. And what are the reasons why our cost of production might change? It might change based on government policies. It might change based on the cost of raw materials. It might change based on technology. So if these things happen, let's say an increase in all this. So an increase in technology, okay, let's say an increase in taxes will bring about a rise in the cost of production, and that will shift the cost curve upward, and that will change our MC. It will change our profit maximizing level of output. Advancement in technology is expected to bring about efficiency, and if that happens, it will increase the profit maximizing level of output. So whatever brings about an increase in the cost for a firm will reduce its profit maximizing level of output. Whatever brings about a fall in the cost of a firm will increase the profit maximizing level of output. So if your cost is increasing, your MC will start increasing more than your MR. If your cost is reducing, your MR will start increasing ahead of your MC. Do you understand? So that is what shift in cost is. Then revenue. When we talk about revenue, we're talking about the receipts of money based on the fact that you have sold certain products. So revenue curve shifts as a result of changes in consumer demand, such as taste, income, prices of related goods, or the number of firms in the market. So we have a change in revenue. Revenue is simply simply the demand for goods. So what will bring about an increase in demand for goods, or what will bring about a reduction in demand for goods? One of the reasons why we could have a shift in demand for goods is because of consumer demands, consumer demand is linked to taste, income. So when we talk about taste, we're talking about preferences of people. Oh, we want this, we don't want that. Popularity of the product. So that might increase the demand for the product or reduce the demand for the product. Income also. The amount of money you have, your disposable income, the amount of money you are able to spend might determine the quantity of goods that you would want to buy. So this also changes the demand curve. I think you get it. So whatever changes the demand curve will change the revenue. We shift the revenue upward or downward. And the last one is the number of firms in the market. If the numbers of firms in the market are reducing, it means consumer choices reduces. Then prices will rise. Consumer might not have other choices. Revenue will rise for firms. Do you understand? And if there are more competitors in the market, revenue for each firms would fall because there are a lot of choices for consumers to make. I think the point is clear.
Yes.
Any question about that?
No.
Good. So that's about shift in cost and shift in revenue. If revenue increases, it increases the profit level of maximizing, or it increases the profit maximizing level of output. If cost increases, it reduces the profit level maximizing output. I think it's clear.
Yes.
Good. So that takes us to the causes itself. So for the causes, I wrote them out anyway. Causes of shift in cost curve. So we're going to start with the input prices. I said, changes in the cost of resources like labor, raw materials, or energy directly impact production cost, causing cost curve to shift. So if labor cost is increasing, the cost of raw material is increasing, the cost curve would shift upward. Technology. Advancement in technology will bring about efficiency. The cost curve will shift downward. Clear? Government policies like taxes. If taxes increases, it shifts the cost curve upward, because at that point in time, firms will not be able to make more as they used to make. And if there's subsidy, it shifts the cost curve downward. I think it's clear. Then we have regulations like environmental and safety regulations. This can also increase the cost of production for firms. And if it increases the cost of production, it shifts the cost curve upward. Clear?
Yes, sir.
Now we go to revenues. Causes of shift in revenue curves. I wrote consumer demands. Shift in consumer demand, consumer preferences, income levels, or prices of related goods can alter the quantity of a product, demand at each price, leading to a shift in the demand. So income, preferences, prices of related products these are factors that consumers will put into consideration before they buy. And if they have to put it into consideration before they buy, it will affect your revenue as a firm. Clear? Any question about that?
No.
Then we have numbers of firms. Hold on, please. Let me see. That's okay. 6. Then we have numbers of firms. In a competitive market, entry or exit of firms can affect the overall market supply and demand, causing shifts in the individual firms' revenue. So numbers of firms in the market. If numbers of firms are increasing, that means there's free entry and exit. It reduces revenue for firms because they have to split the amount of money made through demand. And demand, I think you get the point here. Then demand and revenue. If a product becomes more popular, increased demand, the average revenue curve will shift to the right as consumers are willing to pay more for the product. So we are looking at causes of an increase in revenue, which can be demand and revenue. If the product is popular, demand for it will rise. Consumers will be willing to pay whatever the price is. And as a result of that, firms will be making more in terms of profit maximization. I think it's clear.
Yes.
Therefore, government policy and cost. A new tax on production will shift the average total cost and the marginal cost curve upward. If tax increases, your average total cost will increase, your marginal cost will also increase, and that will reduce your profit maximizing level of output. I think it's clear.
Yes.
Then you have the graphical representation of both. She's here. An increase in cost based on the above stated causes will shift the marginal cost curve upward. As a result, will lead to a fall in the profit maximization level of output. So look at figure 2. An increase in cost will shift the MC curve rightward, leftward, or upward from MC1 to MC2. And that means the marginal revenue will fall. And the marginal revenue falls because your profit maximizing level of output is where your MC equals to your MR. But as soon as your MC is moving upward, your MR is going downward. It means your profit level of maximizing output would reduce. And for revenue, an increase in revenue will mean that your profit maximizing level of output will increase because your MR will be ahead of your MC. Is it clear? Any question about that? Okay, so that takes us to shutdown points. So that takes us to shutdown points in the short run and long run. When I talk about shutdown or short run shutdown, it simply means a firm is temporarily stopping production based on the fact that it cannot cover up its average variable cost. Get the point here? We have a short run shutdown. When a firm is temporarily stopping its operation, it's not leaving the market, but for the fact that it's unable to cover up its variable cost, then there's no point producing. That is what short run shutdown is. So here I wrote, in the short run, a firm should shut down if its price falls below its average variable cost, meaning it cannot cover its variable cost. I told you earlier that short run does not simply means a short period of time. It simply means that period of time which you can start increasing, that period of time that it will take you to increase your level of output. That is when short run is. So within those period of time, if you are unable to cover up your variable cost, your average variable cost, then there's no point producing because you are losing money. So that point is where you have your short run shutdown point. Do you understand what short run shutdown is here? There is a short run shutdown when a firm temporarily stops operation but doesn't leave the market. And why is it stopping? Why is it temporarily stopping operation? It's temporarily stopping operation because it cannot cover its variable cost. If you cannot cover your variable cost, that means the price you are selling or the price you're about to sell is lower than your variable cost. So then you should be thinking about short run shutdown. Do you get it?
Yes.
Then, in the long run, a firm should shut down or exit the market if its price falls below its average total cost, meaning it cannot cover all of its costs, including fixed costs. So in the long run, because in the long run, all factors become variable, right? So if a firm is unable to cover up its total cost, its ATC, then there's no point staying in that market because it simply means you cannot even cover up for your fixed cost. Because your ATC comprises your AFC and your AFC and your AVC. So if you cannot cover your ATC, it simply means you cannot cover your FC. So at that point in time, a firm should start thinking about exiting the market. In the short run, a firm should consider shutdown. That is a temporary stop on operation because it cannot cover its average variable cost. In the long run, a firm should consider exiting the market if it's unable to cover up its ATC. Is it clear?
Yes.
Any question about that?
No.
So we have the shutdown point. The shutdown point in the short run is where you have, these are our shutdown points. These are our shutdown points. Where your AVC is the same as your MC, is a shutdown point. Because at this point, you cannot cover up for your variable cost. And in the long run, we have our shutdown point here, your break-even point. If you cannot cover this, then there's no point staying in that market. I think you get it.
Mhm.
So for that, I think you understand what shutdown point and short run, the long run is now.
Mhm.
So why do we call it short run shutdown? I wrote the short run shutdown occurs when the firm temporarily stops production but remains in the market. So you temporarily stop production, but you're not exiting the market. You can only exit the market. You can only exit the market in the long run when you cannot cover your ATC. But you should only think about temporary stoppage if you cannot cover for your AVC in the short run. So how do you make this decision as a firm? You make this decision when you compare the market price to your AVC. So if the market price is lower than your AVC, then you are going to lose money. There's no point producing at that point in time. Do you understand short run shutdown here? Do you understand, please?
Yes.
So you don't shut down until you figure out, you compare the price you are selling and the price in the market and the AVC. So as soon as you get that, then you would know that, oh, when you temporarily stop producing, you are better off. Then we have the long run shutdown. For long run shutdown, this is called exit. This is called exit, as it implies to a permanent decision to leave the industry or the market. Here, you've compared the ATC with the market price. You figure out that you cannot meet up. And as a result of that, because if you cannot meet up, it means you cannot cover your fixed cost. And your fixed costs are costs that, irrespective of your output, you will consider to incur them. So if you cannot cover them, then what's the point being in the market? So the decision, a firm compare the market price to its ATC. If the price is less than the ATC, the firm should exit because it cannot cover all of its costs, including the fixed cost in the long run. So there's no point being there. So then you think about profitability. In the long run, the firm needs to earn at least a normal profit where your ATC is equal to the price. So if your price is equal to your ATC, that means you are making a normal profit. Then you should still, that will justify you staying in that market. But if you compare your price and ATC and you figure out that your ATC is greater than your price, then you cannot make even a normal profit. Then there's no point being in the market. Do you understand? Long run shutdown. Long run shutdown will occur when the firm exits the market. And the firm is exiting the market because it has compared the price of its product with the price in the market with the average total cost. And it figured out that the ATC is greater than the price in the market. Then it should consider a long run shutdown. For a short run shutdown, a firm would consider a short run shutdown when it compares its AVC with the price in the market and it figures out that the AVC is greater than the price in the market. Then there's no point producing because it's going to be losing money. Any question about that?
No.
Good. Then we have figure 5. I think I've explained all this. So go to figure 5 now. The average revenue curves and the profit outcome. That's what I named it. Average revenue curve and the profit outcome. Are you there?
Yes.
Okay. Excuse me. So we have AR1, along AR1, AR2, AR3, AR4, and AR5. So I'm going to start with the first one. Along AR1, our average revenue is greater than the average cost. Look at AR1. Our average revenue is greater than the average total cost. And this simply means the firm will be making a supernormal profit. So along this curve, any firm would be willing to produce because its average revenue is ahead of its average total cost. That is a supernormal profit. AR1 is clear, right? At AR2, along AR2, AR is equals to ATC. So that means the firm will be making a normal profit. Remember we said when we're talking about the long run, a firm can still consider staying in the market if it's ATC equals to the price. So price is your revenue. So here, ATC equals to AR here. So that means the firm can still consider staying in the market because it will be making a normal profit. Do you understand?
Yes.
Do you get the point or not, please?
Yes, yes.
Okay. The third one. So yeah, I'm just going to quickly recap the first one. I said the first one, where our AR is ahead of the ATC, a firm will be making a supernormal profit. So along this line, any firm will be willing to produce because it's going to be making supernormal profit. And supernormal profit means your average revenue is ahead of your average total cost. So there's a maximum profit being made here. So any firm will produce at AR1. That's along AR1. Then for AR2, where your ATC equals to your AR, a firm can still continue to produce at that point in time because the average revenue equals to the average total cost. So the firm will be making a normal profit. And remember what I said in the long run, I said a firm can still justify staying in the market if the price is equal to the ATC. I think along AR2 is clear. Then for AR3, along AR3, at every level of AR, at every level, AR is lower than ATC. Look at AR. The AR is lower, the ATC is above the AR3. Yes or no?
Yes.
So that means if your average total cost is greater than your average revenue, it simply means you're making a loss. So that is a loss for the firm. AR1 is a supernormal profit. AR2 is a normal profit. AR3 will be considered as a loss because the average total cost is greater than the average revenue. I think it's clear. Then along AR4, the average revenue equals to the average variable cost. So a firm, at this point, a firm should consider what? A short down. A short-run short down at that point in time. I think it's clear.
Yes.
Then for AR5, a firm does not even have to produce at AR5 because at AR5, you cannot even cover anything. You can't cover your AVC, you can't cover you can't cover your TC. So there's no point producing at AR5. I think it's clear.
Yes.
AR1, supernormal profit. AR2, normal profit. AR3, a loss. AR4, temporary shutdown. And AR5, a firm must not even produce at that point in time. So that is the average revenue curve and profit level of our profit outcome. Any question about it?
No.
Good. So that ends profit and losses.